160% in 1974, 157% in 1979, 167% in 1990, and 170% in 2008. Every time oil prices exploded like this, inflation surged, unemployment skyrocketed, and a recession followed. In response to the Iran war, oil prices have once again been surging significantly in the last few months, but this time not 5% or 10%, but roughly 20% of the global oil supply are diminishing. In this video, we show you exactly why history suggests we are heading into an environment of stagflation and how to protect your portfolio before it's too late. This chart shows you the amount of ship transits through the Strait of Hormuz. Before the war started, around 1/5 of global oil supply was transiting this choke point. But with the war causing a blockade, shipping is suspended, causing big supply disruptions. In result, oil prices have more than doubled, surging to above $100 per barrel. But not only oil prices are affected, also natural gas prices have been rising significantly as Gulf nations like Qatar and the UAE are one of the biggest natural gas exporters. The Dutch TTF natural gas price, which is the European benchmark for the price of natural gas, has been soaring heavily in response to the closure of the Strait of Hormuz. Also, the Asian benchmark, the JKM, has been climbing significantly. After the S&P 500 witnessed a 10% correction after the beginning of the war, we are currently seeing it rally to new all-time highs. So the question is, are those valuations really sustainable? Well, it's easy to underestimate the impact of rising oil and gas prices. Many believe only gasoline prices are rising, but that's far from the truth. Also, goods like, for example, fertilizers, which are highly dependent on natural gas, are getting more expensive. When fertilizers are getting more expensive, that causes food prices to rise. As food prices rise, everybody's day-to-day life is getting more expensive. So as you can see, higher oil and gas prices do not only increase the cost of transportation, they trickle down the entire economy. This chart shows you the producer price index in red and the consumer price index in blue. The PPI measures inflation from the business's perspective. The CPI measures inflation from the consumer's perspective. Historically, rising inflation often first led to the PPI rising, as businesses had to increase spending for production or transportation. After some time, this additional expenditure is then transferred to the consumer in the form of higher prices for goods and services. As you can see, the PPI has already been picking up in result to rising energy prices, and because the Strait of Hormuz is still closed with no de-escalation in sight, this upward trend is likely to continue, which is ultimately also leading to rising consumer price inflation. This is important because if you have a look at the US unemployment rate, you can see that historically, increasing inflation always led to rising unemployment. This is what happened in 1974 with the oil embargo, in 1979 during the Iranian Revolution, and in 1990 with the First Gulf War. This is happening because as expenditures for businesses are rising due to rising energy costs, profit margins typically decline. This means businesses have to cut their spending, which ultimately means laying off employees. Now, if you have higher unemployment, that leads to lower demand for goods and services as overall income is shrinking. In result of demand shrinking, that again leads to lower profit margins for businesses, which again leads to more layoffs. So as you can see, that is a self-reinforcing spiral. History shows you that this economic downward spiral often causes negative real GDP growth. This is what happened in 1974, 1979, 1990, and 2008. But the 1970s have been special because the economy stagnated while inflation was still high. This stagnation combined with inflation is called stagflation. So oil prices skyrocketed, leading to rising inflation, causing layoffs and ultimately a recession. Let's now connect this to the bond market and monetary policy by taking a look at the Fed's balance sheet. Whenever this line is moving down, this means that the Fed sells assets which extracts liquidity out of the financial system. Whenever it's moving up, this means that the Fed buys assets which injects newly created dollars into the system. A balance sheet expansion is an inflationary policy which causes currency devaluation and rising inflation. You can see how this, for example, led to rising inflation in 2021 and 2022. Well, the Fed is doing the exact same thing once again. Since December of 2025, the Fed is now again injecting $40 billion into the financial system every single month. This inflationary policy is often disregarded when the cause for inflation is explained. But the truth is, not only the war, but also this policy is currently forcing inflation higher. Before we get into why the Fed is doing this, let us know in the comments. Do you think we are heading into stagflation? So now the question is, why is this happening? Well, this is where everything starts to make sense. The US is currently not only fighting an enormously expensive war, but also has a big debt problem. The gross federal debt has been rising above 121% of GDP, exceeding the levels last seen during World War II. The US tries to deal with the problem by buying US Treasury bonds with newly created dollars. This way, the Fed keeps bond yields low, while simultaneously supplying the US government with the newly printed dollars. This dilutes the money supply, so the real value of the debt is decreasing. At the same time, this decreases the interest on the already existing government debt because yields of the bonds are held artificially low. The point is, this is inflationary. The alternatives are high interest rates and low inflation. However, this could potentially cause a full-blown debt crisis. History shows the US always chose to take the path of inflation, kicking the can down the road. That's what happened in 1974, 1979, 1990, and 2008. Based on history, we at Chronos come to the conclusion that the current geopolitical events, as well as the current monetary policy by the Fed, likely lead to an environment of stagflation. Rising inflation causes rising unemployment, which ultimately increases the probability of a recession. Because of those reasons, we believe that the upside potential for the S&P 500 is limited here, as it seems like the US stock market is currently transitioning into a bear market. Now the question is, how should you position yourself in this environment of stagflation? Well, as inflation runs out of control, we believe that everything that's tied to scarce resources is a good investment. History shows that sectors like energy, consumer staples, and precious metals tend to perform well in times of stagflation. As the war in the Middle East is nowhere near to ending, oil prices are likely to continue to trend upwards. As higher prices for fertilizers lead to higher food prices, consumer staples also tend to profit under those conditions. Precious metals also make up good investment opportunities, as scarce resources are simply good inflation hedges. So the window to position yourself ahead of what's coming is narrow. If you found this analysis valuable, subscribe to our channel and hit the like button, as it helps us reach out to more people who need to understand what is currently happening. Thank you for your time.